Hello and welcome to the Tax Roundup for October. Inside this month, of course, it's all about JobKeeper. We'll take a look at the new rules that have been released, but also the alternative tests as well. Plus, we'll take you through the latest guidance from the ATO on the tax treatment of JobKeeper payments. In cases this month, we'll take a look at the reversal of the Eichmann case and whether land use for storage was an active asset. And now across to Michael for JobKeeper 2.0.
Well, the big news this month is, of course, JobKeeper 2. Now, we've known JobKeeper 2 has been coming for a little while, but we finally now have the detailed rules for how the extended JobKeeper scheme operates, and also more recently, the alternative tests that entities can use to try and pass the decline in turnover tests, the additional tests that need to be satisfied to get into the extended JobKeeper scheme. So I guess the main areas that people are going to be working on for the time being are, first of all, working through those additional turnover reduction tests. And we're going to be focusing on the September 2020 quarter for the time being. And that will normally involve comparing GST turnover, current GST turnover for the September 2020 quarter with current GST turnover for the September 2019 quarter. If that basic version of the test can't be satisfied, then there are a number of alternative tests, and those have now been released by the ATO. Now, for those of you who worked through some of those tests under the original JobKeeper rules, you'll notice that they're quite similar and, in a sense, the same bunch of tests, but with some modifications being made to them. So just because you've used those tests before, don't assume you know how they work, because there are a few little tweaks that have been made to, I guess, the revised versions of those tests. And we're finding that people are kind of now working their way through those in a fair bit of detail, particularly finding the calculation process a bit tricky when it comes to things like the substantial increase in turnover test and the irregular turnover test. So they are out, the detail is there, we know really how those tests work, and now's the time to start working through those with our clients to see whether they can get into JobKeeper for that first phase of the extension from the 28th of September through to the 3rd of January next year. We'll then, of course, have to work through a separate process later on after the December quarter has ended to see whether clients can access JobKeeper from the 4th of January onwards until the 28th of March. Now, the other exercise a lot of people are working through at the moment is determining payment rate tiers for the JobKeeper extension, either the higher rate or the lower rate. And we're typically looking at that 80-hour threshold. Now, remember that there's some standard reference periods that we take into account, which are slightly different depending on whether we're dealing with an employee or with a business participant. But where individuals don't hit that 80-hour threshold under the standard reference periods, be aware that there are some alternatives that might be available. And the onus is on the employer to work through those alternatives and see whether any of them could apply in order to get employees onto the higher rate. Now, the other thing that I should just mention is, from a compliance point of view, when we have clients who will be accessing JobKeeper under the extension, one of the things they'll need to do as part of their first batch of monthly information being given to the ATO is that they'll need to notify the ATO of payment rates for employees and business participants. Now, once they do that, they then have 7 days to notify the employee or the business participant of whether the higher or lower rate is being used and has been notified to the ATO. For Knowledge Shop members, there are some pro forma letters on the Knowledge Shop website, in the member area of the Knowledge Shop website, that will help you in terms of meeting that compliance obligation. So 7-day deadline. Give that payment rate information to the ATO, then 7 days to inform the employee or the business participant of the relevant payment rate. So JobKeeper 2 is now in full swing. It started on the 28th of September. Having said that, until we get to the end of the September quarter, look, there'll still be some question marks for some clients over whether they can access the new rules or not. The next few weeks will be important in terms of gathering information, working through the relevant tests, both at the entity level and also at the employee level, in determining payment rates, making sure that we've got evidence to support the position that we're taking with our clients under the JobKeeper extension, and then getting that information into the ATO as soon as possible so that clients can start receiving those JobKeeper payments back from the ATO. So JobKeeper 2, it's in full swing. We've got pretty much all the details from the government and the ATO that we've been waiting for. It's all there now. Now's the time to start actually applying it to real life and working our way through those provisions.
And now Matthew C is going to take you through the tax treatment of JobKeeper payments.
I'll just talk a little while on the tax treatment of the JobKeeper payments for employers receiving these payments. What's actually been quite useful is the ATO has been continually updating their guidance in this area. So we now have a clearer idea of where things stand. I'll start by talking through the GST bit first. From a GST perspective, things are actually quite consistent. No GST should be charged on the JobKeeper payment, nor should the JobKeeper payment be included in the GST turnover of the entity, which is actually used to determine whether an entity is eligible for JobKeeper in the first place. And the reason for this is because the JobKeeper payment isn't considered to be consideration for a GST supply. Things are quite different from an income tax perspective. The JobKeeper payments will be assessable as ordinary income to the employer unless that employer is tax exempt. The ATO has released some updated guidance, which is probably more and quite relevant for entities with a junior end, just to say that if you're receiving JobKeeper payments for your fortnight ending in June, those payments will be accessible in the following income year, regardless of whether the entity is on a cash or an accruals basis. What we also now know is that the JobKeeper payments won't be included in an entity's aggregated turnover. And this is because whilst the JobKeeper payments are ordinary income, they're not considered to be income earned in the ordinary course of carrying on a business, which is what the aggregated turnover concept requires. This is actually a bit of a relief because the aggregated turnover concept is used in quite a few tax concessions. For example, if an entity has an aggregated turnover of less than 2 million, then this could actually drive whether the small business CGT concessions are available. If an entity is carrying on a business and has an aggregated turnover of less than 10 million, then this means that they could access the simplified depreciation rules, which includes the small business version of the instant asset write-off and the pooling provisions. So it's just important to keep in mind if you're looking to access some of these tax concessions and you're relying on the aggregated turnover, you just want to be careful and ensure that the JobKeeper payments are excluded from that turnover calculation.
In cases, Michael's going to take you through that reversal by the full federal court of the decision in the Eichmann case.
One of the other major developments this month is a case that's gone through the full federal court dealing with the active asset test for the small business CGT concessions. Now, this is quite an interesting case because we've now seen it go through 3 different levels, and the result in each case has gone back and forth each time. Now, this is the Eichmann case, and some of you might recall this was a case that dealt with the use of a property in connection with someone's business activities and whether it was an active asset or not. Now, the reason why this has kind of generated a bit of, I guess, interest and why it has gone back and forth a bit is because the property that the taxpayer held was used mainly for storage of business equipment. So it wasn't like the property was their business premises as such. They weren't actively carrying on their business activities on that property. It was used for storage of business equipment and assets. Well, the taxpayer had initially taken the view that that property was an active asset, that it passed the active asset test because it was used to store business assets and therefore used in carrying on the business. And they applied the small business CGT concessions. Well, the ATO disagreed with that and took the view that the property wasn't used enough in the business, so it wasn't actually an active asset. Well, that ended up before the tribunal, and the tribunal reached the conclusion that the taxpayer was right, that this property was an active asset because it had been used in carrying on the business, albeit only for storage purposes. Well, the ATO appealed that decision and it went to the federal court, so a single judge of the federal court. The federal court went the other way. The federal court said, well, there's a distinction between an asset that is used in carrying on the business and an asset that is broadly or loosely connected with a business. And what the federal court said here was, well, this property, it has been used in connection broadly or loosely with the business, but it hasn't been used in actually carrying on the business and therefore is not an active asset. So the federal court said that the small business CGT concessions would not be available in a case like this. Well, the taxpayer appealed that decision, and the full federal court has now released its decision in that case. And what the full federal court has said is that this property could be an active asset. So the full federal court said that the primary judge or the single judge in the federal court decision had interpreted the legislation too narrowly. And really that interpretation wasn't in keeping or wasn't consistent with the policy intent behind the small business CGT concessions. What the full federal court said was that you don't necessarily need to show that the asset is used kind of in carrying on the business. It's enough that it is used in connection with, that there is some connection with the business activities. So the storage of assets that are used in the business activities on that land could be sufficient for it to be an active asset, and if it's been used for that purpose for a sufficient period of time, to pass the active asset test. Well, this is good news for taxpayers, particularly those who do have property, land, sheds, storage areas that are used for storage of stock, for plant and equipment, for vehicles, whatever it might be that they are using in their business activities. And there may well be some taxpayers who have kind of looked at the original federal court decision and not applied the concessions. Well, those clients might want to revisit the situation because maybe there is now scope to access the small business CGT concessions in those situations. Now, the thing we don't know yet is whether this will go another step further. Will this end up before the High Court? And if so, how will the High Court view this? And we don't know that as yet. So for those clients who might fall within this category of land, property being used for storage purposes, we do just need to be a little bit careful and just wait and see what happens in terms of whether the ATO appeals this decision and whether the High Court agrees to hear it and then kind of have a look at it in detail. But for the time being, pretty good result, I guess, from a taxpayer point of view. Obviously, the ATO is going to be less excited about this, but from a taxpayer point of view, it certainly does open up the small business CGT concessions into some situations where they might not otherwise be available.
And that's the tax roundup for this month. The federal budget is handed down on the 6th of October. Knowledge Shop will be releasing its advisor guide the very next morning. And for Knowledge Shop members, of course, we'll produce that white label client update that you'll be able to distribute and answer all those questions that your clients have. If you're not a member of Knowledge Shop as yet, then give Claire a call on 1800 800 232. We'd love to show you how we make the lives of accounting firms across Australia just that little bit easier. We'll look forward to seeing you next month.